Just a brief look at the Gordon dividend discount model. This is Coca Cola. Now, if you've already watched my videos on the capital asset pricing model, you would have, you would have at least understood how we derive the proper discount rate for a company. In the case of Coca Cola, we look at the beta, which is the company, just to briefly review, and I urge you to watch the capital asset pricing model videos, but we look at the beta times the market rate of return plus the risk-free rate. So when you do that, the risk-free rate now is less than 1%, and the beta on Coca Cola, since it only trades at about 45% of the market movements, we get a value or a risk-free rate of about 3%. So if I take the dividend that Coca Cola pays, which is $1.60, and divided by 0.03%, which is the market rate of return that the market is looking for in terms of risk vis-a-vis Coca-Cola, I'm going to come out with a value of $1.60 divided by 0.03%, which is about $53.33. And you could do that number on your own. Take $1.60 and divide by 0.03%. And that's going to be very close to where Coca-Cola is actually trading. So it shows you that even though the Gordon dividend discount model is an older model, it still is very relevant in this environment because it actually incorporates, real world assumptions, which is the dividend that Coca-Cola pays and the risk that the market is demanding of Coca-Cola. And once again, review the capital asset pricing model, which is basically a calculation of the beta times the market rate of return. And the market rate of return right now is about, the average stock in the market earns about 16%. So you'll find that if you multiply the beta by the market rate of return and subtract that the discount rate, you're going to get a very low rate of return that's being required for Coca-Cola. So you're going to get a value of about $53. And that also shows you that as interest rates move up, as interest rates start to increase, it's going to have a dramatic effect on the price of stocks, because then stocks will be valued at lower prices. Higher interest rates are going to equal lower prices. That will only work out for these companies if they can increase earnings at the same level, right? So if they're not increasing earnings as interest rates are going up, because higher interest rates, right, imply inflation, and inflation means that companies should be able to raise their prices. Well, if the companies can't raise their prices, but inflation is going up, you can see where that could be devastating for the markets, and that's why inflation is such a worry. And that'll be another video I do about the effects of inflation. But once again, do calculate the capital asset pricing model for Coca-Cola, which comes out to about 3%. Look at the dividend that they're paying, about $1.60. Put $1.60 over 3%, you're going to get a value that's right about where Coca-Cola is trading, which is pretty interesting. Not every stock is going to look this way. Obviously, you have to look at the value of companies that don't pay a dividend. Then you got to deal with some sort of different metrics. But at least this kind of gives you a better idea of how the Gordon growth discount model works. Thank you.